Hey, welcome to Retirement Made Easy. On this video, I wanted to talk about the 5 rules for Roth IRAs that you need to know. And these 5 rules just happen to be very, very misunderstood. So I wanted to go through them one by one so you have a better understanding of Roth IRAs and how they're most useful for you. So rule number 1, and there's a ton of rules, but we're going to go through these 5. Rule number 1 is Roth conversions done before you're 59 and a half versus Roth conversions done after you turn 59 and a half. So let's start with Roth conversions after you turn 59 and a half. So if you do a Roth conversion after you turn 59 and a half, you can withhold taxes on the Roth conversion, and there's going to be no 10% early withdrawal penalty on the amount that you withhold for taxes. In addition to that, there is no 5-year rule on the conversion amount that you do because you did the Roth conversion after 59 and a half. So what does that mean? Well, if you did a Roth conversion and you're 59 and a half or older, the money then goes in your Roth IRA. You don't have to wait 5 years. There's no 5-year hold on that money. So you could literally the next month withdraw the money out of your Roth IRA without any taxes or penalties. Let's talk about doing a Roth conversion before you're 59 and a half. Well, let's just say hypothetically, you did a $10,000 Roth conversion, you're under 59 and a half, and you withheld $2,000 for taxes. Well, that $2,000 that you withheld for taxes, you'd actually have a 10% penalty on that. That'd be an early distribution penalty. In addition to that, since you did the Roth conversion under age 59 and a half, there is a 5-year rule. There's essentially a 5-year hold on the amount that you converted in that year. And if you're doing Roth conversions over several series or several years, well, each conversion will have its own 5-year clock or 5-year rule that you'll kind of have to keep track of. So that's rule number 1, is doing Roth conversions. When you do it, the age you do it really, really is key here. Rule number 2 that you need to understand is spousal Roth IRAs. And these are one of the most underutilized tools that I see. So with spousal Roth IRAs, let's say we have a non-working spouse, and you may or may not know, but to be eligible to contribute to a Roth IRA, you need earned income. So let's just hypothetically say we've got one non-working spouse and one working spouse. The working spouse, as long as they make $16,000 a year in 2025, the limit, it does go up or could go up year in and year out. But in 2025, if the working spouse if they're both over 50, and the working spouse makes $16,000, you can do a contribution to the working spouse Roth IRA, and for the spousal, the non-working spouse's Roth IRA as well, $8,000 apiece. So, for all those non-working spouses out there that think, oh, I'm ineligible to contribute to a Roth IRA because I don't have earned income, employment income. No, the spousal Roth IRA allows you to still have your own Roth IRA and contributions going into it because the working spouse's earnings, employment income is taken into account. So this is huge. Again, one of the most underutilized vehicles that I see is the spousal Roth IRA. Rule number 3 is when it comes to beneficiary Roth IRAs. And what is that? That's a Roth IRA that you inherited from the original owner of the Roth IRA. Most often, we inherit a Roth IRA from mom or dad. Well, the key thing to know here is when you inherit a Roth IRA, there is no mandatory annual required minimum distribution. So those distributions, of course, are going to be tax-free to you. And as long as the original owner, had the Roth IRA open for at least 5 years, the earnings will not have any taxes on them. So that's kind of an oddball thing that a lot of people don't know, is they actually do the 5-year rule. Even though the person is deceased, it still would apply. But there are no mandatory annual required distributions from beneficiary Roth IRAs. They're also called inherited Roth IRAs, like there are if it were an inherited traditional IRA. There would be mandatory annual required minimum distribution. And why is that? Well, because basically the IRS, the government says, well, since it's in a Roth, it's an inherited Roth IRA, there's no taxes that are going to be due on those distributions. So they don't make us take those required minimum distributions on beneficiary Roth IRAs. So number 4, when it comes to Roth IRAs and withdrawing money prior to 59 and a half, again, one of the biggest keys to Roth IRAs is you can always take, no matter your age, no matter how long you've had the Roth IRA open, you can take out your contributions to the Roth IRA tax-free and penalty-free. So if you've been maxing out your Roth IRA for all these years, you can kind of look back at your total contributions and you can always take those out. Even if you're not 59 and a half, you can take out the contributions tax-free and penalty-free. Now, the beauty of it is all that growth, the money that goes in, your contributions, they're treated as first in, first out. So when you go to take distributions from the Roth IRA, you take your contributions first and the earnings stay. All the growth, all the earnings, that stays put. So it allows you the ability to literally take money out of this Roth IRA, even if you're not 59 and a half, even if the Roth IRA hasn't been open 5 years, and you haven't met the 5-year rule, you can still take those contributions out, again, tax-free, penalty-free. So huge benefit to Roth IRAs. The other thing, rule number 5 is Roth IRAs. Of course, you need earned income to contribute to Roth IRAs, but there is a cap. There's an earnings limit where you might be canceled out, where you make too much to contribute to Roth IRAs. So that limit does go up, seems to go up every single year. If you're curious what the current limit is, you can, of course, go to our website, RetireStrongFA.com. Under the Resources tab, you can download our tax guide, and that'll show you what the current Roth IRA income limits are. And for those of the people that are above those income limits, you're not left out. You can still, as of the recording of this video in 2025, you can still take advantage of what's called a backdoor Roth IRA. That's for the high income earning people that are above the contribution, the income limits to be able to contribute to a Roth IRA. They have the ability to do what's called a backdoor Roth IRA that's contributing to a non-deductible IRA and then converting it to a Roth IRA. I would encourage you to, if you're going to do that, make sure you file the appropriate tax forms on your tax return. Speak with your tax advisor and your fiduciary financial planner. Whoever your financial advocate is, you'll want to have that discussion to see if the backdoor Roth IRA makes sense for you. I will argue that for a lot of people, especially the people maybe with big IRA, pre-tax IRA balances, it might not make as much sense for them. But again, you'll want to rely on your tax advisor and financial planner to help you determine if it's going to be a good idea or not. I hope this video with Retirement Made Easy has been helpful. I'll see you next time. And remember, always dream big. Hello, I'm Greg Gonzalez, founder of RetireStrong Financial Advisors. If you want to see more videos like this, please like and subscribe. And if you want to learn more about how we help people plan for a successful retirement, visit our website, RetireStrongFA.com.